At the time we're speaking to you, we're waiting for gilt markets to open this morning, and that's going to be important, is it, as a kind of verdict on the appointment of John Healey, because that happened after gilt markets close. But what do you make of the gilt market story right now? There is a danger, we've seen this with perhaps the last couple of budgets, or at least the last one, that the markets are just always waiting for the next budget to take place.
Yeah, I think, in terms of the setup, I think the assumptions we had heading into yesterday have been undermined. A, we thought Mahmood would be Chancellor, and then B, we thought, Burnham would play relatively safe with the fiscal rules. We've now seen that Healey's going to be appointed Chancellor, and yes, we don't know loads about what exactly he's going to bring to the table, but the obvious inference is higher defence spending, given how he left the Keir Starmer administration, and the question is, what crowding out effect does that have? Then for Burnham, obviously, he carries a lot of sway. He's First Lord of the Treasury, of course, and also he clearly has a stronger policy platform that we've seen with Starmer, and he's now shown signs he wants to play a little bit more loose with those fiscal rules. And we've seen that this morning. We've seen they're going to cut taxes on energy bills. There's a lot of questions about how exactly that's going to be funded. And I think if you take that at a time when energy prices are high, that is going to be negative for gilts. We've seen UK 10-year yields around about 5% yesterday already. And I think in the short term, UK paper will probably underperform that of the US. We saw that soft US CPI report last week. And yes, we may see the budget later this year, massage some of those concerns eventually, but there may be a bit of a runway where, we are going to see more fiscal angst. I think from an FX perspective, the pound doesn't really care too much. I think the higher carry is more important. Yeah, and there's a debate, isn't there, as to whether or not the energy story emanating from the Middle East actually has a bigger impact on UK assets than maybe domestic politics. You've been thinking about the European stocks and relative resilience in the face of the geopolitical headwinds? Yeah, I was off last week, and then I came back yesterday. I saw Brent was on a 90 handle, European natural gas prices were at multi-month highs, and Stock 600 was doing nothing. In fact, it had done nothing when I was away. We're down 2% from all-time highs. And month to date, Stock 600 outperforming the US, outperforming Asia. And I think part of that is, kind of optimism that eventually a deal, will be sought between the two sides. We've seen some reporting over the last 24 hours suggesting that is the case. But I also think from a macro perspective, there's a relatively high bar to price a growth shock from the conflict at this stage. PMIs really never rolled over that much in the midst of the conflict. They rose last month, expected to do so again. And then also, the fact that there's a high bar to price a growth shock is allowing Q2 earnings to be in focus, which are relatively strong, expected to show up momentum throughout the year. And Europe's also offering an offset for any tech angst in the market. Yeah, talking tech angst, briefly, Adam, we're going to get tech earnings, aren't we? The start of them this week. I'm still not sure if we're looking for big capex numbers or less big capex numbers. I think it's a case of threading the needle. You don't want too high capex. You saw that from TSMC last week. You don't want too low, because you'll see AI angst resurface. I think the key is, how did chip stocks react to this? Are we going to see rotation out of chip stocks into hyperscalers, or are we going to see good tech earnings lift all boats? I think that's the key focus we need to look for. Adam Linton, thank you very much indeed from Bloomberg Markets Live.